China threatens a global recovery as the U.S. economy starts to reach escape velocity. All that and more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today because we're seeing in the data the U.S. economy is showing signs of recovery. Every time it stutters, it starts to come back. But the problem now is China, who is slowing down and doesn't just threaten its domestic economy, but the global economy. Let's pick the story up where we see here China's slowdown poses threat for global recovery. That's the emerging consensus is falling property prices, which, as you know, we've been covering, nervous consumers, and a cooling manufacturing sector. Now, I want you to think about the cooling manufacturing sector and where that comes from. Now, remember, China's an export nation, so if their manufacturing sector is cooling off, what does that mean for the world's largest importer? Keep that in the back of your mind as we go through the data today. Sector all points to slowing momentum in the world's number 2 economy. A surprisingly restrained policy response from Beijing, which means they're not doing anything, has dampened hopes for more support. Translation, hey, we wanted more fiscal, and at least for now, they're not getting it. And here you can see the slowing recovery as China's economic activity continues to lose speed, industrial output declining on a year-over-year basis, retail sales declining on a year-over-year basis, and it is running below what we would consider trend for China, putting threats of a possible contraction in the future if the slowdown continues. To put the turnaround into context, only months ago, economists had banked on China cruising past 8% growth rate for 2021 and carrying strong momentum into 2022. This is important. Everybody's looking to China for the growth story. While this year's expansion may yet hit the forecast range, the slowdown means Goldman Sachs Group and others warn China could see sub 5% growth. Now you might say, sub 5%, that's not a real big deal. For China, it's a big, huge deal. For the world economy, the developed threatened to strip away a key ballast of support. China's hunger for raw materials and its quick reopening after the initial pandemic wave helped fuel the global rebound, and that is the key. So when you see China falling below trend growth, that's a problem. Although policymakers have started fine-tuning some policies, and state and media reports are fanning speculation of an easing in curbs, economists warn the downturn in real estate, as you know we've been covering, which accounts for up to 25% of output, could hurt the wider recovery. And again, that is the challenge for China. They've slowed down their credit. It's translated into the real estate market, which is a huge portion of their economy. And potentially, when we look at the U.S. data, we see signs of recovery, an emergence out of this doldrums. But maybe that's just lagging data of what is to come in the fourth quarter of this year and the first quarter of next year, which could be a major fiscal cliff. But let's take a look at the China's data here to see. We see the macro data weakens across the board as a credit impulse. Now you wonder, what is credit impulse? That's the net credit creation. That's what was tracked in the credit impulse. Contracts most in 10 years. I mean, that's outrageous. Here you can see the Bloomberg Economics China credit impulse 12-month net change, deeply negative. Last time we saw this was in 2010. And if you remember, we were coming out of the great financial crisis. And what did we see? Nearly a double-dip recession, this time not led by the U.S. Then it was led by China as it curbed credit expansion. And every time they do that, you see here, double dip recession, almost double dip in the U.S. We saw a slowdown, almost a recession, and now what do we see again? The risk of a recession because China's credit impulse leads. This is a key. It's a leading indicator often of where everything goes. And you think about that in terms of credit creation. If I'm going to go out and borrow money to buy a car, the first step would be borrowing money. So that's why the credit impulse matters. It's the first step. I don't get the car and then borrow money. That's the key. So credit impulse leads the economy, and that's what has a lot of people worried. Let's look at the data. Now you can see the slowdown. China industrial production year to date, year over year up 10.9% beat, but down from September 11.8. How about retail sales? Beat on month before 14.9, but down from 16.4. So notice how the trend, month to month may be off a little bit. Overall, the trend is slowing. Fixed asset investment up 6%. Pmis down from 7.3% in September. Property investment, no surprise, Pmis at 7.2%, down from 8.8. And what do we see? Survey jobless claims 4.9 unchanged as The jobless rate remains the same in China. And here you can see the China 70 cities newly built commercial residential buildings prices on a month-over-month average. And wow, what have you seen now? It's down. Now you say 0.25%, it's not that big of a deal. And in terms of home prices, it isn't. It's just a broad indicator that what we're seeing is a slowdown in the real estate market. When prices fall, that's telling you consumers are not as eager to buy, so prices are coming down. It's not good when you have a massively over-leveraged property market, and that is indeed this China's problem. Consumers get nervous, don't want to buy property, and then all of a sudden the debt unwinds. We'll keep a course. We'll stay on that story as it further develops. But for China, Evergrande slump may be harder to shake than COVID. Of course, we already know that's coming. The slump reflects, because the whole story about Evergrande, as we talked about, it doesn't end. It's just not a story that says, okay, they made their bond payment. These other developers made their bond payment. It's the next one. And that is the challenge because they need dollars. Of course, we know there's a massive dollar shortage. We'll look at that in a little bit if we got some circumstantial data to prove that. But this is an ongoing story. Will they make the next payment? Well, that is the question. The slump reflects the combined impact of a number of factors. First, among them, the weakness in real estate. What a surprise. And a real estate company has a problem because of the weak real estate market. The troubles of cash-strapped developer China Evergrande Group are emblematic of a sector that's overbuilt, over-leveraged, and now with sales slowing, struggling to pay its bills. Of course, we know it's not the only real estate developer having these problems. With property accounting for about 25% of China's GDP, its woes exert a significant drag on the broader economy. Taken together with energy shortages, recurring outbreaks of the virus, growth is now way below heady expectations of a combined V-shaped rebound for last year's contraction. That, my friends, threatens the U.S. The China slowdown comes as the world's economy, now key, world's economy, second largest economy, China, largest exporter, grapples with another challenge, inflation that remains stubbornly high. Think of, now I want you to be thinking, this is a story that's going on in the U.S. right now and may accelerate even faster. Again, same story as the U.S. The nowcasts show that U.S. inflation is set to end the year 4.6%, more than double the Fed's target. Of course, we know the Fed is going to taper to help to curb that. Inflation in the Euros area and UK is also running hot, while Team Transitory, the central bankers and economists who argued inflation would quickly fade, is in retreat. If there's one silver lining from a China slowdown, and this is key. Now substitute word China, here's what we do as we go through this. Take the word China and substitute it for the U.S. because this is what's coming here. I know many of you know that. So silver lining from a China slowdown, though, it could be that weaker demand starts to take on heat out of prices. So in the future, we'll say U.S. slowdown could be that weaker demand starts to take the heat out of prices from oil to iron ore and soybeans. Fears of weaker Chinese imports could trigger a drop in prices, which in turn would reduce sticker shock for consumers in the U.S. and Europe. And that, of course, if you're concerned about any of this, what happened, though, from a central bank standpoint, well, this gets interesting, doesn't it? For the rest of the world, China could bring another twist to the central bank drama. In 2015, the global risk-off moment triggered by the collapse in China's stock market delayed the start of the Fed's tightening cycle. The same thing could indeed happen again. Now remember, we've been talking about, and the Fed has just recently talked about, if you tuned into Monday's show, what did they say? Hey, we might want to be able to raise rates. We might be able to end the taper sooner. Of course, that has its own risk, as we covered on Monday with slowing down the money supply. Of course, if you're concerned about any of this with your portfolio, be sure, there we go, check out, got the right finger up, for sure to check out Portfolio Shield. But how about the U.S. data? Because it's a story right now. We start looking at the October data, and we go back 1 month to September, and what did we see? The national economy contracted, and now what's happening is it expanded. So here we see the Chicago Fed National Activity Index jumping to 0.7, and that is a huge number. Now, if this is on trend, it should be 0, so 0.7 is a big increase. We see sales, orders, and inventories up 0.5. Now, it's not percentage, it's 0.5. Consumption, housing, pretty much 0. Employment, unemployment up 0.64. So we're seeing some of the data that we've been watching transmit through to the national economy, and production and income way up at 1.35. So we're seeing this in the Chicago Fed data. We're also seeing it in existing home sales. They're up 6.3% 4 million units. Forecast is at 6.2. How about the preliminary market manufacturing PMIs? Remember, a 50 is unchanged. Above 50 is the rate of expansion. So what do we see? The bigger the number, the faster expansion. A little bit of an increase in the preliminary numbers in the manufacturing sector, showing it's expanding at a bit faster rate than the month before. And how about the services sector? They're expanding at just a slightly slower rate than the month before. Overall, when you see a 59 and a 57, great numbers, putting the composite, a blend of the two, at 56.5, a decent number for sure. And of course, what do we see when we take a look at that composite data? We see actually the trend is slowing down. So perhaps indeed that China credit impulse is actually leading to a slowdown, perhaps will impact the U.S. manufacturing sector. But what is some validation of this dollar shortage that we talk about? It's none other than the auctions. So what do we see in the Treasury auctions this week? Now, due to the holiday week, they got crunched up into the first couple of days. And a lot of people get these auctions wrong. When they see weak demand, they misinterpret it. Let's take a quick look at the 5-year and what we know is indirect bidders or foreign bidders. Now, this isn't going to be all China for sure. We see that the percentage, it's not shown here, is actually down. We saw that in the 2, the 5, and even the 7-year this week. And what does that mean? It means when you understand the scenario, everyone looks at these auctions and says weak demand means higher interest rates. It's not how the game actually works. It's not how the global economy works. Where does countries like China get their dollars from? And when they export to the U.S. and we pay for goods and services in dollars, dollars flow overseas. So when they buy fewer treasuries, it's telling you, it's validating there's a slowdown. Even worse, I want to challenge you to think about this. The U.S. exports inflation by exporting dollars. So when you see a slowdown in the auctions, what happens then? If we're not exporting as many dollars, does that mean we're not exporting as much inflation, so we're importing more inflation? No, in a slowdown, it means we're importing deflation. And with that, thanks for being fans. Thanks for watching. We'll, of course, see you back on Friday for the show. Hope you have a great holiday. For those of you in the U.S., I'm Steven Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only. Is not intended to provide investment or other advice. This video is not to be construed as recognition or solicitation by selling securities, transfer instrument, or participate in particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity. Opinions expressed in this video that do not affect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.